today in the business world at www.bworldonline.com, we can see that the news says that Pisang plans to cut debt by 25 billion this year. So other news says that Vivant to invest 433.8 million pesos in Subiri's power firm. And one of those news also is that new virus surge to delay Philippine recovery. Reading further, new virus surge to delay Philippine recovery. So a fresh surge in coronavirus disease 2019 or the COVID-19 infections will likely further delay the Philippine economy's recovery. This is according to the S&P Global Ratings, which said on Monday. If recovery is derailed, S&P said in a separate report, the financial buffers of some Philippine banks may not be able to absorb a rapid deterioration in asset quality. So the first that will be affected will be the Philippine banks, the banks. So we have invested or we own Metropolitan Bank Trust Company. So we know that from the start, the pandemic will surely affect the bank. That's why we bought, because people will become pessimistic about the outlook of the bank, so they will sell it off. So that's I think we grabbed the opportunity to buy Metrobank or Metropolitan and Trust Company, Metropolitan Bank and Trust Company, because of the negative outlook for the banks due to the pandemic. Some holders of shares of Metrobank will sell it off at a lower, even at a lower price, even at an unreasonable, unjustifiable price, like a very low, because they said that the banks will surely be affected, of course. But in the long term, of course, government have to support their banks, because banks is the backbone of an economy. It reflects how well or how healthy a country's economy. Without the banks, we don't have financial institution, we don't have a company where we can deposit our money, we can do our financial transactions. So as we have a bank, in order to avail of the automated teller machine, so we can withdraw or get our money anywhere. So continuing, the major emerging markets in this region. So Indonesia, Malaysia, the Philippines. So the Philippines is one of those major emerging markets in this region, Southeast Asia, including Thailand, are living with the effects of new waves that only recently look to have peaked. S&P believes, that's S&P belief, that's the belief of S&P anyway. This could prolong their paths to recovery, it said in a note. Delay risk on the rise for Southeast Asia's recovery. So belief is just a belief. Of course, they have to support that belief in order to believe it. But sometimes belief can be true or false. Okay. The Debt Watcher's baseline forecast for the Philippines this year remains at 9.6%. However, they have a very good forecast for the Philippines, that it has a 9.6% forecast, much faster than the Philippine government's 6.5% to 7.5%. Last year, the economy slumped by a record 9.5%. So the economy of the Philippines went down to negative 9.5% as the government implemented one of the world's strictest and longest lockdowns. The baseline estimate assumes the Philippine output level will return to its pre-pandemic level by December 2021. Although downside risks to this view have emerged due to possible surges in COVID-19 cases. This is a slower recovery, so compared to Indonesia, Malaysia, Indonesia they will be recovering according to S&P. That's according to S&P. That will mean to Indonesia, S&P thinks that Indonesia will go back to its pre-pandemic level by April 2021, Malaysia on July 2021, and Thailand on August 2021, where output will likely recover to pre-pandemic levels earlier in the year. So in our investment or in our company of SPC Power Corporation, of course, whether there's be a new surge or just the pandemic period, we still have the people will have the same demand as it is because they need power. The business needs power, household needs power. Okay. So the biggest threat to timely economic recovery is individual consumer behavior. As people stay home more and spend less, it said, defining recovery as quarter-on-quarter growth that is above trend. So household consumption accounts for at least 70% of the gross domestic products in the Philippines, and nearly 60% in Indonesia and Malaysia. So the gross domestic product of the Philippines relies on household consumption, on the way people consume, like they go to the restaurant, they buy food on the market, like that. Because 70% of the gross domestic product will come from that. So that means when the government will pay its debt, they have to tax that 70% in order to generate the income to pay the debts they have incurred to fight the pandemic. So it will be the household who will shoulder the debts of the government, who will be the household who will be in the future or the coming days who will eventually pay the debts that the government have made to fight the pandemic. So going further, given the continued downside risk from the COVID-19 outbreaks, S&P trimmed the sequential growth outlook for the Philippines. If recovery is delayed by 2 months, S&P expects GDP growth at 7.7% this year. GDP is expected to grow by 7.4% if there is a 4-month delay in recovery, and by 7.1% if there's a 6-month delay. If recovery is delayed by 6 months, Philippine output will only return to pre-pandemic levels by May 2022. So that will be next year, if recovery is delayed by 6 months. So the vaccine must be here already in order to not delay that 6 months period. So in a 6-month delay scenario, we factor in more economic scarring caused by a prolonged recession, which causes a greater amount of permanent, so that will be a permanent damage to the economy, greater amount to permanent economic damage. That's according to S&P. That's their belief. But of course, it's up to you to assess that will have a permanent damage. Of course, anything that's already broken will be damaged. If it can be recovered, of course, that will be a question. The longer an economy is stuck with unemployed resources, so human resources, commercial resources, natural resources, so that will be unemployed because of a longer economy that is in recession, the larger the damage to balance sheet and workers. So not only the workers, the unemployed workers, but also those companies that have unemployed assets, machineries. It will, of course, will not earn the machineries. Even the natural resources, if you will not use the natural resources, that will be unemployed. So unemployed capital, unemployed machineries, unemployed workers, of course. But since household consumption accounts for the 70% of the GDP, so that will be a very uh, big impact, and it might be a permanent damage. So more businesses would close. So that would be the S&P term for economic scarring. And more workers would lose jobs, skills, and motivation, it added. Amid testing capacities compared with Western economies, S&P noted hospital capacity is a more important indicator of government policies. So they cannot test everybody in the Philippines. So now they relied on the hospital capacity to see the trend as an indicator of government policies compared with reported cases. The Depth Watcher baseline scenario is that the region will see widespread distribution of vaccines by the second half of the year, which could then boost economic activities. In the Philippines, infections rose 2,288 to reach 563,456 on Monday. Data from the Department of Health record showed more than half of isolation beds, 62%, intensive care unit, 68% beds, and ward beds, 78% remain available. So there's still available beds in the hospital, a fairly large number, so it's okay. So vaccines are expected to arrive in the country within the month. The government is targeting to inoculate 70 million Filipinos by end 2021. Government officials have been pushing to further ease restrictions to drive economic recovery. Long road to recovery. In a separate report, S&P said the Philippine banking industry is on a long road to recovery. So that means, according to them, the Metropolitan Bank and Trust Company they see that the banks like Metropolitan Bank and Trust Company will have a long road to recovery, with asset quality seen to further deteriorate as banks recognize the extent of the pandemic's impact on borrowers. The Debt Watcher said the industry's non-performing loan ratio may reach 6% in 2021 from 3.6% in 2020. So this negative news will make an opportunity to buy more shares of banks, particularly Metropolitan Bank and Trust Company, because in the longer term, they will go back to that pre-pandemic level anyway. High provisioning in 2020 and capital buffers can buy the sector time, assuming the economic revival stays on track. Our negative outlook on rated banks reflects our view that financial buffers could not absorb the rapid deterioration in asset quality, likely to ensue if the recovery is derailed. S&P analysts Nikita Anand and Ivan Tan said. So they're analysts. So NPLs could spike in the first quarter as loan moratoriums and fiscal support end. We believe NPLs could peak in the second half. Non-performing loans. NPLs means non-performing loans. So a rebound in economic activity as well as ultra-low interest rates should support borrowers' repayment ability in 2022. So that will be next year, they said. Banks will likely see mild recovery in profits this year. and are not expected to return to pre-pandemic financial performance until the year 2023. S&P analyst said. If this is what happened, so today is year 2021, so according to them, they expect that banks will recover and return to pre-pandemic financial performance in the year 2023. So we have still 2 years more to buy those shares that will be dumped in the stock market. So we will be not only bargain hunting, so we will be garbage hunting. So a man's trash is another man's treasure. Okay, guys, thank you for watching. See you on our next video.